Welcome back to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoan. Today, we're diving into the latest developments in the Canadian real estate market, starting with some important updates from the Canadian Real Estate Association. The Canadian Real Estate Association has recently revised its housing market forecast for 2024, reflecting a slower than expected return of buyers. Initially, there was an anticipation that the first interest rate cuts this summer would spark more activity in the market. However, the association now predicts that home sales will remain subdued until the spring of 2025. It seems many buyers are holding off, hoping for better rates in the near future, which has led to this adjustment in the outlook. According to the Canadian Real Estate Association, they now expect 468,900 homes to sell through Canadian multiple listing service systems in 2024, which represents a modest 5.2% increase from 2023 levels. However, this figure is below the earlier expectations. In terms of pricing, the average home price is forecast to edge up just 0.9% next year, reaching $683,200, before rising more significantly by 4.4% in 2025 to $713,375. The association anticipates that home sales will gain stronger momentum in 2025, with a projected 6.6% increase as interest rates continue to decline and more buyers re-enter the market. Many potential buyers, who might have previously entered the market with a 3-year fixed-rate mortgage, appear to be delaying their purchases in anticipation of lower rates that seem just around the corner. This cautious approach has resulted in what the Canadian Real Estate Association describes as a holding pattern for the housing market, with little movement expected until the spring of 2025, when more significant rate cuts are anticipated. By then, the market is expected to gain stronger momentum, with a sharper rebound in both sales and prices. Clay Jarvis, a spokesperson for NerdWallet Canada and a real estate financial expert, has likened the current situation to the moment just before a starter pistol goes off. He notes that while the market is loaded with new listings, buyers are still hesitant to dive into large mortgages. Jarvis also suggested that a 50 basis point rate cut from the Bank of Canada could quickly change buyer behavior, making variable mortgage rates much easier to qualify for, and potentially triggering some homebuyer fear of missing out, or FOMO. However, it's important to recognize that some buyers might wait for additional measures from the government to help them enter the market more comfortably. For those paying down large debts or rebuilding their down payment savings, lower rates alone might not be enough. If they're waiting for the country's new insured mortgage limit to come into effect in December, the housing market could remain in this holding pattern for the rest of the year. The Canadian Real Estate Association's next forecast is scheduled for release in January 2025, but for now, it appears both buyers and sellers are playing the waiting game, holding out for more favorable conditions. On December 15th, the federal government will implement changes to mortgage rules aimed at making it easier for individuals taking out insured mortgages to purchase homes. This move is expected to boost Canadian home sales and prices next year. However, the impact of these changes may be dampened by several factors, including the erosion of affordability that could accompany their implementation. From a financial stability perspective, mitigating the impacts of these policies could be beneficial, as these measures might encourage households to take on more debt over a longer term. Historically, insured borrowers have been more susceptible to financial stress, making this a significant consideration. The federal government announced 2 specific changes to Canadian mortgage rules, effective December 15, 2024. These changes aim to make it easier to qualify for home purchases. The Canadian housing market has shown to be highly reactive, as seen with the surge in home sales early in 2024 and the spring of 2023. However, it is believed these measures alone will not trigger a housing boom. Instead, they might provide a secondary boost to a market already gaining traction in 2025 due to lower borrowing costs and a gradually improving economy. One of the measures involves expanding the maximum mortgage amortization period for first-time homebuyers who take out insured mortgages from 25 to 30 years. Additionally, amortizations will also be extended for purchasing newly built homes, which could help boost activity in the new home market and support housing construction. This is not the first time the federal government has extended amortization lengths. Back in 2006, the Canada Mortgage and Housing Corporation started a pilot program to insure mortgages with 30-year amortizations, which later became permanent. Although these policies have historically had a statistically significant impact on Canadian home sales growth, the effect has been relatively small. In the current scenario, a first-time homebuyer with a typical family income and house price could see their purchasing power increase by about 9%, roughly equivalent to a 90 basis point interest rate reduction. While this is a meaningful difference, the impact on the market may be limited, as it only applies to first-time homebuyers with insured mortgages. According to the Bank of Canada, only about 44% of total sales are to first-time buyers, and a mere 20% of mortgages issued this year have been in the insured space, though this number could rise following these policy changes. Another policy change involves raising the cap for which a potential buyer can obtain an insured mortgage from $1 million to $1.5 million. For instance, a buyer purchasing a detached home in Toronto valued at $1.2 million could now put down $95,000 as a down payment instead of needing $240,000 previously. This policy could significantly boost activity, particularly in the Greater Toronto area, where a substantial share of homes falls within this price range. However, there are challenges associated with this policy change. For example, a buyer putting down the new minimum down payment on a home valued at $1.05 million would need a household income of about $170,000 to $180,000 to meet typical qualification thresholds, which could be difficult for many first-time buyers. Moreover, 80% of Canadian households had incomes below $150,000 in 2020, suggesting potential limitations in the policy's reach. Despite these limitations, the federal mortgage rule changes are expected to provide a notable lift to home sales and prices in the first half of 2025, contributing to a robust year for sales and price growth. However, the impact will be tempered by various factors, including the decision to limit amortization extensions to first-time homebuyers and the challenge of aligning the higher insured mortgage cap with the income levels of potential buyers. Ultimately, these changes might encourage households to take on more debt over a longer term, which, from a financial stability standpoint, could be seen as a positive development. However, the potential for some financial fragility to be introduced into the broader system remains a concern. The federal government's newly announced program to help homeowners refinance insured mortgages for adding secondary suites has sparked a mix of reactions across the mortgage industry. Starting January 15th, homeowners will be allowed to refinance up to 90% of their home's value, capped at $2 million, to create up to 4 self-contained units. These units, such as basement apartments, in-law suites, or laneway homes, are intended to generate rental income, excluding short-term rentals, and help increase the housing supply. The refinanced insured mortgages can be amortized over a maximum of 30 years. While the program is seen as a positive step toward boosting supply, some industry players express caution, noting the need for more clarity on implementation details. Lauren Vondenberg, President and Chief Executive Officer of Mortgage Professionals Canada, acknowledged the program as a step toward alleviating housing affordability pressures. However, she emphasized that it does not fully address Canada's need for increased construction capacity to meet the demands of a growing population. Vandenberg pointed out that this program creates new opportunities for brokers who can adapt to clients seeking to refinance their mortgages for these projects. She highlighted that brokers will need to stay informed about the new mortgage insurance reforms and the secondary suite loan program, as guiding first-time refinancers through the rules could make the advisory process more challenging. Concerns have also been raised about the lack of specifics from the federal government regarding the program. Ron Butler of Butler Mortgage expressed frustration over the absence of technical details, questioning the government's reliance on what he termed amateur construction to address the housing crisis. He emphasized the complexity of control mechanisms required to implement such a program effectively. Tracy Valco, owner and chief visionary officer of Valco Financial, cautioned against viewing the program as a comprehensive solution to Canada's housing crisis. She noted that while the program is a valuable tool, It primarily adds rental units rather than building new homes or facilitating home purchases. Valco also questioned whether the government had adequately consulted with lenders and insurers before launching the program, expressing hope for more clarity in the coming months. Lee Graham, mortgage broker and co-owner at the Mortgage Professionals in Kingston, Ontario, highlighted the challenge of waiting for lenders and insurers to gain access to the program. Graham believes that while the program is a positive step, its success depends on the timely involvement of lenders and insurers. He expressed optimism that the program will create more borrowing and lending opportunities in the brokerage sector once fully implemented. The Canada Mortgage and Housing Corporation recently released data that indicates a rebound in Canadian housing starts for September, marking a 5% increase from August. This uptick translates to 223,808 units on a seasonally adjusted annual rate basis. However, industry analysts caution that this rebound, while welcomed, does not sufficiently address the ongoing housing shortage that continues to plague the country. Despite this temporary increase, the 6-month trend for housing starts has actually declined by 1.9%, highlighting a persistent slowdown in construction activity. When we look at the year-to-date figures for 2024, housing starts have seen a modest 2% increase over the previous year. This growth is mainly driven by multi-unit and single-detached developments in provinces like Alberta, Quebec, and the Atlantic provinces. Unfortunately, Ontario and British Columbia have experienced significant declines in housing starts, with Toronto and Vancouver reporting decreases of 20% and 19%, respectively, compared to 2023. Kevin Hughes, Deputy Chief Economist at the Canada Mortgage and Housing Corporation, pointed out that while there is growth in certain regions, the overall picture remains concerning. The decreases in Ontario and British Columbia are particularly troubling given the high demand for housing in these provinces. The current level of construction activity is simply not enough to address the affordability crisis in Canada's urban centres. Clay Jarvis from NerdWallet emphasized the need for a substantial increase in construction to make any real impact on the housing shortage. Jarvis noted that while the rebound in September is a positive sign, it is far from sufficient. He argued that Canada needs a significant and sustained increase in building activity to address the shortage effectively. The challenges facing the construction industry, such as high costs and a shortage of skilled labor, are expected to persist, particularly as we move into the winter months. Jarvis mentioned that while the government's upcoming housing design catalog, set to be unveiled in December, may ease some of these challenges, it is not an immediate solution. Kevin Hughes reiterated that despite the short-term improvements in housing starts, the outlook remains grim. To restore affordability in urban centers, a much more aggressive approach to construction is needed. The current figures, although showing some improvement, are still falling short of what is required to meet the housing demands of a growing population. As we wrap up today's episode, let's take a closer look at the evolving landscape for mortgage brokers in Canada. Recent developments suggest that more regulatory changes could be on the horizon, particularly in the realm of anti-money laundering and anti-terrorist financing compliance. According to Francis Hinojosa of Tribe Financial, mortgage brokerages across Canada are already adapting to new requirements set by the Financial Transactions and Reports Analysis Centre of Canada, or FINTRAC. These changes, which took effect on October 11th, place brokers and lenders under the purview of the Proceeds of Crime and Terrorist Financing Act. This means implementing robust compliance programs, having rigorous know-your-client processes, reporting transactions, maintaining comprehensive records, and applying ministerial directives. Hinojosa believes that this is just the beginning of increased oversight in the industry. She anticipates that FINTRAC will continue to update its requirements, suggesting that mortgage brokers should be prepared for further changes in the coming years. The goal is to bring mortgage brokering regulation more in line with the oversight of other financial institutions, such as banks. It's worth noting that brokerages should have already had comprehensive compliance policies in place, even before these new regulations. Hinojosa points out that the broker of record is always responsible for compliance, highlighting that it is crucial for brokers to run their businesses with proper policies and procedures tailored to their specific operations. Despite the challenges posed by these new regulations, Hinojosa does not foresee a wave of consolidation among brokerages. Instead, she emphasizes the importance of creating and implementing effective policies and procedures that ensure compliance. By staying on top of these requirements, brokerages can continue to operate successfully without necessarily merging with larger networks. The introduction of these changes is part of a broader effort to combat money laundering and terrorist financing, which have been identified as significant threats to the real estate and financial services industries. In British Columbia, a high-profile investigation known as the Cullen Commission highlighted the vast amounts of laundered money flowing through the province's real estate and casinos. This investigation underscored the need for stronger regulatory measures to protect the integrity of Canada's financial systems. As we move forward, mortgage brokers will need to remain vigilant and proactive in adapting to these evolving regulations. By doing so, they can help ensure the stability and security of Canada's real estate market while continuing to serve their clients effectively. That brings us to the end of today's episode. Thank you for tuning in to the Ontario Mortgage and Real Estate Insights podcast. I'm Steve Hammond, and I look forward to bringing you more insights and updates on the Canadian real estate market in our next episode. Until then, take care and stay informed. And